Hello, folks. Dan Bird here on Wednesday, October the 9th, right in the middle of a hurricane. But so far, things are actually fairly calm. It's eerily calm and quiet right now. I'll show you what it looks like in a second. But I just wanted to do a very quick midweek update while I still have power, assuming it holds. So we'll see what happens. So let me quickly switch over and share my screen. And for those that are interested, my website is breakpointtrading.net. And there's a free newsletter that you can get right here in this box. And if you want to register your email to be alerted that the newsletter is available, down at the bottom of the homepage, the $0 doesn't ask for a credit card. We don't share emails. If you want to take advantage of everything on here, it's $99 for the year, which includes a lot of content. And there's a 7-day free trial if you want to try the monthly subscription. So that's, we'll use some of this tonight to talk about some of the things that are happening. First, let me show you what's happening with the hurricane. So this is as of about 5 p.m. Right now it's about 5:20 on the East Coast. I am right here where this blue dot is. So it looks like it's going to come ashore right about Sarasota. Actually, Siesta Key, if anyone knows where that is, it's a beautiful stretch of beaches right there. Beautiful white sand beaches, Siesta Key. But that's where it's going to hit, probably at a category 3 or low level 4, high level 3, something like that. But that's where we are right now. You can see right now, everything is pretty quiet where I am. Most of the rain and everything is to the north of the hurricane. The winds are going to definitely pick up once this gets a little closer to land. It's pretty close right now, actually, but it's supposed to hit probably around 11 o'clock tonight. And it's going to push the storm surge all the way down the coast, and the winds will pick up later on. Hopefully by tomorrow, this will all be over. But so far, it hasn't been too bad where I am, but I do feel bad for the folks up there in Sarasota and the Tampa area. So give them all a prayer if you could. Let's take a look at the, from Stock Traders Almanac, what the typical trend for October looks like. And I think we're going to buck this trend a little bit. So usually in October, the dash lines are for election years. And you can see we are here right now, October the 9th. So we're right basically at the bottom of this trend. Now, all years, not just election years, are pretty flat until we get into about the 3rd week of October, and then things take off right into the end of the year. But this is actually happening a little earlier, and I'll show you what the charts look like in a second. And I think, and I've talked about this before, I think the reason is there are some positive catalysts. The unemployment rate came in healthy last week. The Fed cut rates by 50 basis points. They will likely cut again by 25 when they meet in November, and probably again in December. So the market will like that. And tomorrow we have CPI. So that's what I want to talk about tonight, because this comes out tomorrow. And that is going to be, I think, a major driver. And I think it actually started driving the market today. The other chart that I have that I want to show you is this one. This is something I found that shows the date of the first rate cut, the 1-year, 3-year, and 5-year return after that first rate cut. So you can see up here, in general, the returns, the 1-year returns, there have been some negative areas in there. The 3-year have been much more positive. 5 years, a little bit negative in 1998 and 1970. But in general, it's been mostly green. Now, the other thing that I did, since I always talk about secular bull and bear markets, is I highlighted the ones that are secular bulls. Those are the ones here on the left in green, highlighted over here in green. And the secular bears are the ones here in red and down here in red. And what you should notice is that in secular bull markets, when the Fed cuts for the first time, in general, it's pretty green. The only red ones were 1987, which is where the flash crash happened in October. The 1-year return wasn't so great. And then 1998, the 5-year return, because after that, think of 1998, 5 years takes us into the dot-com crash. So the long term wasn't too good there. But in general, the secular bull market was very healthy. In fact, some pretty big numbers here. 1-year return, 17%, 25, 18, 20%. Here's the last Fed cut in 2019, and 1-year return was 8.9%. Now remember, this went right through COVID. So COVID happened in February, started in February, March of 2020. And then the recovery started about 2 months after that. So around May. And by the end of the year, there was a V recovery. So you can see, even with that first rate cut in 2019, that nobody knew at that point in July of 19 that COVID was coming. But even with that, the market ended almost 9% higher in 1 year. So that's even with that big, huge downtrend and V recovery with COVID. 85% for a 5-year return since then. And we've been in a secular bull market ever since then. So the latest Fed cut was also in a secular bull market, which just to remind everybody, I'll show you what that looks like on the homepage. Halfway down, this is the secular bull market. I actually extended this now back to 1980. So this is the secular bull from 81 to 2001. They usually last about 20 years, 18 to 20 years. This is the secular bear market from 2001 to 2013 officially, when it broke out of these highs. And we are currently in a secular bull. So we're right at the top of the channel, but you can see all of the indicators, the momentum indicators, even though they're near the top, they're not yet rolling over. And this is a monthly chart. So this takes a long time for this to actually roll over. So we've got a good time still left into this bull market. So very bullish. Everything is really bullish right now. And I will show you that as well. So if we go back up to the top, we'll actually look at the S&P. Right here, it broke out. I said last week this is probably going to happen. Broke out today. So now we're again at new all-time highs. The NASDAQ, which was lagging the S&P, broke through this resistance line. It has not yet broken to all-time new highs, but it's well on its way there, and it probably will break out to new highs again. So everything is extremely bullish. Bitcoin, however, is giving back some of the gains that it had. So Bitcoin is rolling over and starting to head back down again. And then the other one in here, the Dow is down here, but this is the US dollar, and you can see how strong the dollar has been. After declining for quite a while, it now is extremely strong. And gold is rolling over a little bit. Bonds are still heading down. I think they will recover. So it might be a time to take a look at getting in on the dip. And then there's the dollar heading higher. And the 10-year yield has just been screaming higher since the beginning of October. But I think that's going to level off and start to roll over. It's actually already started to slow down. Momentum has slowed down a little bit. You can actually look at the 10-year on the charts page, where most of the charts are located. Down here we have, under the economic charts, 10-year yield right here. And here's what it looks like. So it's got the 200-day moving average that it will have to contend with right up here at about 4150, 4.1%, let's call it. And I think it's probably going to start to level off around this area and start to decline. And when that happens, the bonds will reverse as well. So these are inverse relationships right here. So you can see how bonds have come down as the 10-year has gone up. We'll watch that. That doesn't mean it will, but that's what I think is going to happen. It's going to reach a certain level and start to level off and move sideways at that point. This one right here is the inverted yield curve, and the pink horizontal line is 0. So anything below 0 was inverted, and it was inverted for 2 years. And it uninverted in the beginning of September 3rd, actually. It uninverted, started to head back below 0 again, and we're just kind of moving along the side right here. The shorter term one, it's not on this chart, but bonds versus stocks right now, bonds are underperforming stocks. So stocks right now are the place to be. Everything looks really bullish. And let's take a look at the CPI, because that's what's going to happen tomorrow. And if you'll notice CPI right here, CPI is calculated based on a 12-month average called the base effect. So that's what's in this blue box. So in September, you can see that a very big one dropped off. So when a large rate of change drops off from a year ago and a smaller one gets added, then the overall CPI drops. So you can see right here, the previous month it was 2.9. It was forecasted to be 2.6, and it actually came in at 2.5. So went down 0.4%. That was a big drop in CPI. And this is the reason, the main reason, because of that base effect. Now look what happens tomorrow. Another one, not quite as big as this, but still also a very big one. So we're probably going to come in around 2.3, I think. There's a chance even better than that. And then it levels off for a couple of months. So it's going to kind of stall around 2.3 for a couple of months. It might even tick higher back to 2.5. And you know, all the talking heads will say inflation's coming back, just like in the 80s. The Fed cut too soon. They should have waited, but it's not. Inflation's not coming back. In fact, if you look at the ones dropping off over here from February, March, April, and May, big ones dropping again. So next spring, inflation is going to be below 2%, and it's going to look like it's dropping like a rock. So we're going to be in the ones in the springtime. So keep an eye on that. But because of this tomorrow, the market will likely, and just out of curiosity, I want to take a look at, see what the forecast right now for CPI is for tomorrow. This week, right here, CPI is 2.3. So you can see right there, the year over year forecast is 2.3. I think it will probably come in at 2.3. There's a chance because it's also a big one dropping off. Like we dropped 0.4 the last time, went from 2.9 to 2.5. I don't think we're going to go below 2.3, maybe 2.2, but because commodities have come up and oil and gas have increased as well. Now, if we look at the commodities on here, right there, you can see the month that it's going to be reported tomorrow is this blue area. And you can see all the commodities. CRB is agriculture, energy, and metals. DBA is all agriculture, food products, basically. That's this one up here. So, and copper is right here. And gas and oil actually went down a little bit for last month. And that's the reason that we're still going to get that decline. But if these continue to go higher, the next CPI might be a little bit challenged. But the one tomorrow is going to be very positive. And everyone's going to declare victory against inflation. And even the jobs number looked pretty good. So it basically looks like a soft landing and maybe even no recession next year. So that will be very positive for the market. If we look at a 2-year chart of the S&P, you can see right here, again, that's where it's breaking out right up there. But this all looks extremely bullish for the S&P. If we look at a 3-year weekly, so a longer term, again, right here, even though we've got this negative divergence, that can go on for quite a while. So right now we just broke out again, and we might even break above this trend line, which actually will move the trend line up. So all of this looks very positive. The other thing I want to show is what's happening with the sectors. So I'm going to show you the aggressive and defensive sectors one at a time. These are the aggressive. This is a 5-year weekly chart. These are the sectors on the top. The bottom blue panel is the relative of how they perform versus the S&P. So you can see a zero line down here on this one, zero line at the bottom. So that's how are they performing versus the S&P. So first, look at the actual number, the actual chart. So every one of these are the aggressive sectors. They should be going up when the market's going up. Every single one of these are screaming higher. Now, discretionary is underperforming the S&P, while technology is very much outperforming. Communication services, where the internet stocks are, is basically flat. Industrials are flat, and financials are slightly underperforming. That's going to change, though. I think financials are going to continue to take off, and they're doing really well from a real basis. All right, so keep that in mind. So all of these are moving higher. Now, on a relative basis to the S&P, they cannot all outperform. They can't. There's only 11 sectors. So if some of those sectors are outperforming, then by definition, other sectors have to underperform. And technology makes up more than 30% of the overall S&P. So if it's outperforming right here, you can see by 50% outperforming the S&P, and it makes up 30% of the S&P, then by definition, other sectors have to underperform relative to the S&P. However, they are all outperforming. They are all going very much going higher. If I go back and look at the defensive sectors right here. So here we have staples. Again, look at the actual chart. Staples screaming higher, utilities doing really well, healthcare doing really well. I think that's going to continue. Materials doing great, energy is doing great, even real estate is doing great. Now, from a relative basis, these are all underperforming, except for energy actually is basically at zero. So remember, technology makes up 30% of the overall S&P, but every single one of these sectors are moving higher. There is no weakness anywhere in any of these sectors. So the market is absolutely going to go higher. I think we've had a lot of very positive catalysts, from good jobs numbers to the Fed cutting to tomorrow, the CPI, I think is going to be positive as well, and it will continue to send the market higher. So keep that in mind. Everything looks really bullish right now. These are the trend models from stock charts, and these are the main sectors for today. This is just today's view. So technology and healthcare are the two top performing. Utilities was the bottom. And these are the top performing large cap stocks for today. Carvana, interestingly, is right at the top. And Palantir right there has been doing really well. All of these are great stocks, and most of these are in the top 10 lists that I publish every week, which is on the charts page as well. Right down here on the bottom right, these are the top 10 lists. So you can see VST is right there. App was on there. Palantir is in 2 of the lists, the middle one and the far right one. Far right one is the IBD 50 ETF. These are the best performing strong earnings, and these are relative outperformers versus their industry group. So all of these top 10s are excellent performers. Here's Carvana, appeared in this one, and you can see the chart for Carvana has just been trending higher. So these are great stocks to identify when they have pullbacks, to jump into them, because they have proven themselves to be in the top 10 over and over again, week after week. All right, so that's how we look right now for Magnificent Seven. You can see SMCI, and I want to show you that one here in a second. SMCI just gave a short-term bull signal. So if you have been waiting or watching to get into SMCI, now's the time to maybe start to take a look at it. Amazon and Microsoft still have short-term bear signals. So we'll have to see if those will switch. And AMD has a long-term bear, but AMD does really well in October and November. It's 2 of the best months for AMD. But let's take a look at the Magnificent Seven trend model. The trend model basically does nothing more than shows you the short-term, medium-term, long-term trend, and it shows you the dates where those changed. So we can see Amazon just gave a short-term down signal on October 7th. And here's SMCI. So if we look at SMCI, they've got earnings coming up on the 11th. I'm sorry, on 11/5. If we look at SMCI, we can see where there's the signal, short-term up signal, and it has been in a downtrend for quite a while. It gave a long-term downtrend right here at the beginning of September, but these look like they're starting to reverse right now. Still risky because it's in an overall downtrend, but if I do the zoom, look at the zoom in for SMCI, you can see right here, it's right at its 50-day moving average. So if we can get above the 50-day right there, there's the signal where it's the short-term signal. There's the early entry signal. So if it can move up into this cloud and then above it, then this might continue to take off and recapture the uptrend that it had previously. It's still risky. This is the long-term on the left side over here. This is the zoom out signal. So this is a weekly chart over 3 years or 2.5 years. 2 years, sorry. Over 2 years, you can see that it has been in a long-term uptrend right up until recently. And this shows you the long-term down and the long-term down signals were given right here. So you would like to see that to get back above the cloud here as well. So that's why it's still risky, and it should be considered as a short-term trade. So just keep that in mind. A couple of other ones that are interesting, take a look at. Intel, interestingly enough, it hit the bottom right down here below 20. It started to rally, came back down to the 50-day moving average, and now starting to rally again. So it's right in the cloud, which is basically a neutral area. And if it continues and breaks out of above, and it still has to get above its 200-day. So it's got a lot of work to do. But Intel is one of those stocks that probably is not going out of business. I think it is right about at its value price right now. So this is one, again, if you want to take a chance on it, I would put a stop in down here at the 21-day, but that's one to take to watch. The other one that I want to show you that I showed last week when I showed you how to find good stocks and then how to track them using this paper trade worksheet, which essentially gives you a way of journaling your trading to see, how things are working, if things don't work, why didn't they, things that you should try to avoid in the future, and also what kind of scans to use to identify good stocks. I just wanted to show you Oracle is still in here. These are the ones that have dropped out down here. And Affirm just got added yesterday. I want to show you Affirm. It got an early up signal for the scan, and I get alerts on these every day. So this is what Affirm looked like yesterday, this vertical line right here. So that was the entry point. You can see it got a short-term up signal today right there. We look at this a little bit closer. So you can see it's above the cloud. It's above all of its moving averages, all of the trend indicators, momentum indicators. This one never went below zero, and it's starting to turn up. So Affirm is one that looks like it probably is going to continue higher. The stop right here is at about 36, I think, 37. Let me look again. Stop right now is at 37, so that'd be 11% loss if it went down to that point. Purchase price was 41.50. So what you can see with the chart is that it's already at 43.25. So the buy price was 41.50. It's almost up more than 5% since the buy price in just one day, basically. So we'll continue to watch this, and the idea is to continue to move the stop up as the price moves up. But these alerts I get every day, and I'm going to start tracking those, and on the YouTube channel, track and show everyone how I do those scans, and we'll track them, see how successful they are. All right, so that's it for today. Stay safe out there. I still have power, obviously, so that's a good sign. And hopefully the hurricane is not going to cause too much damage here. It's going to really hit around 11 o'clock tonight. So most of the winds are going to be after dark, probably between 10 and 2 in the morning. And tomorrow we'll see what the damage is. But so far it's been actually very eerily quiet here right now because it looks like it's going to hit Sarasota. Anyway, that's it for the market. I hope everyone has a great week. Give me some comments. Let me know if there's any particular stocks or symbols that you want me to make any comments on, or we can use these charts here to identify what they look like. Just let me know. All right. Thanks, everyone. Have good luck trading.